In today's video, we will go through a question asked by one of the users in the comment section. I believe that the answers to the question might be relevant to most of y'all who watch uh, the channel for the perspective of learning how to trade. So let's just get straight to it. So the comment is, Sir, I have backtested the golden cross system. So now what is the golden cross system? You would remember that we had covered the 2050 moving average crossover on the time frame in which we identify the trend, and when the 20 period moving average is greater than the 50 period moving average and they are sloping upwards, then we are looking at what is known as a golden cross. In other words, the golden cross simply means that the trader should hold a long bias into the trade. So the individual is saying, I think the person is Fin Video. The person is saying that he or she, because it's difficult to know if Fin Video is a male or a female, but the person is saying that they have backtested the golden cross system, which is the 2050 moving average crossover system, and found it highly effective and hassle free. Yes, it is very effective. Any trader who's asking you to trade the 20, the 50, or let me break it down, any number from 5 to 200, those trades have to work provided the security begins to trend. Moving averages are dynamic supports and they are only useful when the security is trending. If you ever see a security if you ever see a security pierce through a 20, 50, 200 moving average, much like hot knife through butter, you can be very sure that the security is no longer trending. Now, whether to use a 20 period moving average or a 200 period moving average, that depends on the individual's time frame. That is, how long is the person willing to hold on to a position. Individuals who are trading very, very short durations would prefer to take up a smaller moving average on a smaller time frame, while ultra long term investors could use a larger moving average on an even longer time frame. By choosing larger moving averages, you are essentially forcing yourself to hold the position longer, because it is very difficult for a stock to break through 50-month moving average compared to the difficulty it needs to surmount in order to convert the pierce through the 50-day moving average. That is, a 50-day moving average would be pierced far greater number of times than a 50-month moving average, which in turn would be pierced far fewer times than compared to 50-week moving average, and so on and so forth. So now, what moving average to choose, what time frame to choose, are the subjective decisions of a trader. What we have tried to cover in that particular series of using moving averages coupled with ADX is to focus on the technique. What does focus on technique mean? It means that the video attempts to teach you how to drive. Now, logically, whether the road is bumpy or the road is smooth, if there is a lot of traffic or if it's regular traffic, if your car is a supercar or if your car is a standard sedan, in such a case your approach to driving will change. So this this is a variable specific to each individual. Now the person is saying that I am planning to deploy it and have a few questions, which is good. So the first one is, should I consider a death cross? So yes, death cross basically means bearish setups. And if you are trading on the hourly chart or even the daily chart, then trading bearish setups makes a lot of sense, because because you would note that even structurally bullish stocks could turn bearish for maybe say 1 to 3 months, 6 months in between. So it depends on the time frame that you're trading. If you're trading a very shorter time frame, then yes, you could trade the death cross setup. And also it depends on how many instruments you're trading. If you're going to only trade the Nifty, then you cannot just be long on Nifty. Then you will have to have a system which allows you to be long and short on Nifty. So is the case if you're just trading crude oil or if you're just trading gold and so on. So if you're trading just 3 to 5 securities, then if you're trading fewer than 5 securities, then of course having a sell side system is important. But let's assume your watch list is 250 stocks. Then in such a case, it will become very confusing for you to maintain all the details for a long side as well as details on the short side. It is not impossible, but the complexity is increased. You would have to change the indicators as you change the direction, and it requires more documentation and greater work. So the upside is that you would be more effectively positioned in the market. The downside is that your work would not double but maybe quadruple or 10x, even though you're just trading the second direction. So this is a very subjective decision. But to answer the question from my perspective, in my first 8 years or 9 years of trading, I was trading on both directions. This is the only year that I have decided to be a net long and long only trader, because it is my view that the market is likely to trend up for maybe a couple of decades, and I need not I at the current stage, I feel that a robust percentage growth on the kind of capital that I have and occasionally taking good leverage sets me up for success without risking too much on the downside. But when I was trading with much lesser capital in 2015, 16, 17, 18, where even 100% growth on the capital didn't really mean that much. It wouldn't change my life. It would be good for the account, but it wouldn't change my life. I was obviously trading in both directions and trading a lot. So initially in your career, I would encourage you to trade a lot and in both directions. But later, if that's assuming you're becoming a professional trader, but if you are working in an IT firm, or you're a shopkeeper or a farmer or a doctor, that is, you have a separate business line, a separate income source, and you're looking at trading as an additional income source, then even just being long only or short only is quite useful. So it's a subjective decision. I don't have a yes or a no answer for that. Here he is or she is giving an example that Kotak Bank recently gave a clean entry near the 20 moving average. Reasonable, that's correct. But its options lack liquidity. Should I go with futures instead? Definitely. The only reason why you should trade options is because you have a very, very, very small underfunded trading account. So you're essentially a poor person, but you have the aspirations of becoming extremely wealthy. That's the reason why you are buying into options. But if you are a businessman and you appreciate the challenges associated with trading, and your job is obviously to find out the right stock in the right direction, correctly planned in position sizing and everything, which is already a tough job, you won't make it tougher by selecting an option. So the reason why I gave examples with options is because if I give an example with just pure futures, then people think that I have a negative bias on options, or I feel that options are untradeable, which is not true. I have traded options extensively. They have contributed significantly to my learning as a trader. But when I was trading options, I wasn't trading Kotak. I was trading Nifty. So Nifty options are far liquid, but Kotak, if you're finding it difficult to find liquidity in Kotak Bank, which is a Nifty 50 stock, just imagine the challenge you're going to find in, let's say, for example, Indian Bank or Bank of Baroda. Bank of Baroda is fairly liquid, but let's just say IndusInd Bank. Now, what's going to happen is these stocks have a very, very wide range, but no liquidity. So logically, if you are looking to create a wider watch list, I would say from day one, focus on being optimally funded. Know the risk that you're carrying, say 5 to 10% on the future contract value. That's generally the risk. You could optimize it using ATRs and whatnot, but typically, if you're carrying forward the position 5%, you should expect that what if there is a 5% gap down, and go for it. The individual writes, the only concern is the margin. Of course, that's the only reason why futures is a concern, but otherwise I have limited doubt that futures is a vastly superior instrument than options. Not because of the nature of future, but simply because of the nature of costing. The current costing in the exchanges is designed to exploit the small retail trader. So what the exchanges have done is they charge 10 times more for trading the option as compared to trading the future. So as long as you are an extremely small trader, then the price for your financial freedom is far higher. But once you become, ironically, once you become a larger trader, then the price of trading is significantly lower. So I can understand that the individual is finding the margin high when the margin required is just 1.5 lakh. Now you see the amount 1.5 lakh and could be so subjective from person to person watching the video. I don't mean to sound snobbish, but this is the fact of the business that you cannot pursue professional trading with a structurally underfunded account. And if you are underfunded, then it is possible to survive and thrive as a trader, but you will appreciate the initial role of luck in that particular account. So I believe that 1.5 lakh personally is not a large value, but given that the average income of an Indian today is 1.5 lakh per year, that's $2,000 approximately, or maybe 2 lakh a year if we convert it now that the dollar is higher. You see, to put the average annual income into the market for trading one lot of stock future automatically means that the market is not accessible to a large population of the country. And this is not bad for the market. I mean, the intention of the regulator is to protect the small investor or the small trader from losing of their life savings. So while that intention is there, and I mean, they could even help them by lowering the cost of trading options or reducing the lot sizes, but it's very difficult to articulate stupidity reasonably. So my view is that if you're really underfunded, then just go long on equity and swallow the bitter pill and accept that you are currently not in the position to be a professional futures trader. But if you have success in the equity market for 3 years, I am very confident that you would learn much more than just the 2050 crossover that I have explained in my videos. And with this added knowledge, discipline, increased trading capital, when you finally do make the change to futures, you would be better than the beginning future trader at that time. But you will be head and shoulders above them, which greatly enhances your chances of survival. And the longer you survive, the greater are the odds that you're going to pick up an absolute monster of a stock. So my view is that don't focus on yourself, don't focus on what you want, focus on what the account needs. So don't ask yourself, don't put yourself in a position where you say, I want to be a futures trader. If only I were a future trader, I would be very rich. That's not how the problem statement needs to be articulated. The question is, for a person with a trading capital of 2 lakhs or lesser, what is the optimal trading strategy? That is the question. And your focus has to be to answer that question. Someday your capital will be 20 lakh, perhaps maybe 2 crore, maybe perhaps 20 crore. We do not know the future. But when you have that capital, you will ask that question. What should a person with, let's say, 250 crore do in order to maximize their risk-adjusted returns? And your answer at that time, I can assure you, will not be do direct equity only. At that point in time, the more sophisticated instruments that exist and the potential of so many business ventures that you can enter into give you a wider variety of options, and it is your job to be the custodian of the balance sheet that is given to you and to work in that framework, because your balance sheet is going to define the roles and responsibilities that you have in life. And of course, it is logical to seek greater challenges and recognition and responsibility in life, but it should be consistent to a large extent with your balance sheet, and your leverage should be just around that. That is, if you are, let's just say, middle class, then you should behave like a middle class person in the market also. If you are, let's say, elite rich, like you are, I don't know, $1 billion worth or more, you must behave in the market like that also. That is, a dollar billionaire is not out there punching their orders. They have contracted a couple of people or a couple of teams in order to do this activity for them. But there is not a single dollar billionaire who is not invested in the market. I would go on to say that it is simply not possible to reach that level of wealth without somehow being in the market. Now the question is whether the person got into the market after they became a dollar billionaire or in the process of it. 99% the answer is going to be in the process of getting wealthy they got into the market. So similarly for you, in your journey of becoming wealthier, you should get into the market, and like any business, be well funded. So my view is you could really consider going Kotak equity at the level that you found appropriate. So I've shared that. Question 3 is, when you followed this system, what was your starting capital? So my starting capital was 1 lakh rupee in 2015 in the equity segment. And I don't remember when I started trading commodities, but perhaps 2017 or 18 I traded commodities with a starting capital of maybe 25 or 35,000 rupees. Was it fully yours? 100%. That capital was fully mine, and it was funded from my salary, and it was an amount that I considered sizable, but it was never an amount that if I would lose I would be crushed. It was even lesser than my 1 month salary when I started with that. Or did you pitch the idea to your clients or relatives too? So first of all, I'll talk about relatives. I have lost a great deal of friends in this process. For example, you all would have heard that I said that 2022 was the only year in which I booked a loss in my trading. That was the first year that I booked a loss in my trading career, and it happened almost 7 or 8 years after I started trading. And I had a friend who started with roughly 5 or 6 lakhs rupee with me, and you would remember that 21 October market started correcting because they anticipated a Russia-Ukraine war, and somewhere around January 22 there was a huge fall in the market, which was far greater than what we experienced in the last 6 months. But at that time, we in India did not know that there is going to be a Russia-Ukraine war. But of course, the big investors around the world knew it. And in that first wave, I think I was totally caught off guard because I was hugely profitable and I had never experienced a loss, so to speak. In that, I remember that I had friends who had 5 lakhs, maybe 2 lakhs, 10 lakhs, this kind of money in the demat accounts, and they asked, and my dealer would punch the orders for them, etc. And I had a friend who lost like 50,000 rupees or 60,000 rupees in that particular year on an account of 5 lakh rupees. And believe it or not, that person really, how do we say, like how you reprimand a subordinate, the person was reprimanding me for losing 50 or 70,000 rupees in the market. And his point was, how could you lose 10-20% in just a month or a quarter? How is it even possible? How incompetent is it? I thought you were good, but of course you're a loser, and so on and so forth. At that point, when he was making all those statements, I realized that, essentially the person who had put 5 lakh rupee with me is a person whose father is an industrialist. They're third generation business owners, and I think he must be worth maybe 50 crore rupees as family net worth, or maybe 100 crore rupees. I felt that the person had put 5 lakh rupee simply to use my performance to put me in my place. And the only thing that I learned in that is that, thank God that the person abusing me is a person I know. It could have been far worse had I gone out all over the world, or had I set my own PMS. Because even though I was a profitable trader, the pressure and the processes completely change when you are managing other people's money. You need to wait for their compliances. If they're late in giving an order, you will miss the trade. Inevitably, the person would miss some trades which would work, and would almost certainly get into trades which are failing. So when I started trading for others, what I started doing, I obviously learned from that experience. I'm very I'm quite thick-skinned that way. I didn't really feel anything, like I wasn't feeling bad or something for what I had heard. I could have easily put the person in his place, but that was not my objective. I was really just seeing it as a feedback. So what the key takeaway for me was that in order to become more successful at managing other people's money, I need to operate the account on larger time frames so that my dealers get sufficient time to take confirmation from the client, and even if the client delays it by a few minutes or a few hours, the impact is not huge. Because earlier I was trading, let's say if I bought a stock at 100 rupees, I would literally exit at 99.4. And if we don't get the trade confirmation by then, it's it would either be a missed trade or a trade gone horribly wrong. So logically I just simply changed the way I approached it, and from a 0.6% I moved it to a 6% SL, and things started getting better. Any change is not easy. That is, in 2021 I used to actually trade using the hourly charts, but to trade on the hourly charts for 100 plus people waiting for their confirmations was simply overwhelming the team. And if the market became tough, you see, if I lost say 10 consecutive trades, I would feel bad, but I knew it, I had to trade again tomorrow. But if others lost 10 consecutive trades, they would simply not want to place another order again. And you as a trader already know that your biggest trade is going to come in the most volatile and unfavorable market circumstance. So you are not going to miss out on that big trade also. And this becomes a process. It is very difficult because my company Arthigamya is not like Motilal Oswal. We don't have people who are in the CRM department who are going to call up people and ask them to stay invested regardless of where the market is. We have kept our focus purely on the technical aspect of work, and literally we do not do any marketing, post-marketing call to anyone asking them to add any kind of capital. We only spend around 10 to 15 minutes or 25-30 minutes depending on the person before they are onboarded, and after that literally we have no discussion with them. And this is a matter of choice, because what I have learned is that even your best friends are going to sit on top of your head and abuse the living daylights out of you for losing just 50,000 bucks, and they could be like multi-million dollar $1 million worth. So even if your very good friends are going to sit on top of you, a random person is going to they're just going to completely defame you. So given that I know that is the possibility, the framework is structured in a manner that the person would, they can do what they want, but there is nothing also in a way. They cannot do anything concrete or significant. So that is the method, and it is done in a manner that I can do my job better. Of course during that phase I lost not just clients, but I also lost friends. But also during that phase I ended up making great friends who were actually clients, because the clients who experienced that loss were still seeing a structure in how I was operating. In other words, when the client is in your system, if a client has experienced a loss of 10, 20, 30 lakhs in the F&O market, they already know what the F&O market is all about. But when your own friends are experiencing it, who have zero experience of the F&O market, they are in a shock. And all of a sudden 50,000, 1 lakh rupees seems like a huge amount to them. So yes, so what I learned is that the best clients are clients. You don't have to make a pitch to your relatives. You just have to make yourself reasonably visible, because it's not like you are Edelweiss or Anand Rathi. You're never going to be that in the current framework in the immediate short-term future. So just do your normal stuff, like post on LinkedIn, post on social media occasionally. 1 out of 100 people will inquire, 1 out of 100 of them will convert, and that is life. Easy life, fun life. So I initially pitched the idea, but now I don't pitch the idea to anyone. In fact, actually after years of persistent, people pitch their capital to me. I'm not trying to brag, but that is the reality. When people call me up, they say I'm concerned. You can feel the trepidation that I only have 10 lakh rupee trading capital. You can feel the trepidation in their voice itself, and I am glad that they structurally know that they are underfunded, and then the conversation proceeds. Question 4 is, how did you grow your capital over time using the system? So let me clarify, it is not just this system. Basically, system refers to a process of decision making, and the process of decision making is a function of certain input parameters. I can change the input parameters based on what I'm really looking for in the output parameter. I know this might sound slightly ridiculous, but just because I'm advocating trading trends does not mean that I have never traded ranges. Or just because I've given 80% weightage to trend does not mean I've never traded giving 80% weightage to price action. So you could say that what I have taught here is, first of all, done with the objective of social media teaching. Firstly, it should be easy. It should be something that individuals with a very low background in trading also can understand, and it should be something that is scalable, because the difference is going to start coming once you execute 100 trades. See, the thing is, people do not understand how much you learn when you execute 100 planned trades. They're so focused on making the money that that they are not understanding that it is the learning which is scalable. If you make 1 lakh rupee in the year, what have you changed in your life? Nothing. 8,000 rupees per month to you, and if you're living in a family of 4 people, it is 2,000 rupees per month per person in your family. Like, nothing changed in your life. If you invested 1 lakh and made 1 lakh, that is 100% return in a year. So nothing changed. What changed? What changed is your learning, which sets you up for the potential of better years, which is what makes life exciting. So the profit of 1 lakh or 1 crore is not what is exciting. What is exciting is the potential of infinite profit, which is the virtue of a good system. And like I said, that if you, whether you own I don't know, Tata Nano, or whether you own, I don't know, like a Mercedes, both these vehicles are capable of driving you down from Delhi to Chennai. Both of them. I means it. What just differs is basically. What just differs basically here is your experience as driving, basically. So my point being that. My point being that I grew my capital through learning, and I was lucky to profit at some critical points, and I believe that I can obviously teach what I have learned. That is truly scalable. I believe I can teach someone everything that I know, but I also believe that in the end it is going to be their relationship with loss, money, streaks of profit that is going to govern their ultimate success in the market. So here with these videos, I'm simply an enabler of some content. That's the intention. What was your mindset during that phase? Mindset, I was hyper competitive, hardworking, critical, analytical, and pretty much addicted. Like, addicted to trading, addicted to the process of trading, addicted to charting. I do not know how many hours a day I was thinking about it. I simply do not know the I would just look forward to markets, and if the market closed in here at 3:30, I would start trading commodities in the evening. And once the commodity market closed, I would dummy trade MT4 accounts for international markets. So I was just continuously trading. So the mindset was of a person who's obsessed with their craft. Where did you fund? Where did your additional funding come from? Profit saving or external? So basically, I mentioned that my transition has been very smooth. I have worked for almost 10 to 12 years before I quit my employment to become a trader. And what happens is, when you complete 5 years in a single firm, you get gratuity, PF, and when you quit employment, you get PF. I am definitely someone who was in the upper percentile of the country as far as salaried income was concerned. I would make a couple of lakh a month at that time, and I didn't have those kind of liabilities. All my liabilities were negligible compared to what I was earning. But what I did anticipate in my early 30s is just this huge, or late 20s, is that this huge expense that is going to come, which is going to make the salary look. A lot of the salary is just going to go off as an expense. So which means that if I didn't take action, then it looked pretty moderate or mediocre. So yes, so the additional funding came from my employment career. And like I mentioned, that it is very rare that a person is a good trader in the markets but a horrible money manager outside of the market. It is slightly rare. So I would say that I come from a background which is very critical about spending, very critical about about being lenient with capital. So that background also helps a lot. Like we have grown from a modest background, basically. Like we are first second generation immigrants, and so logically we have a different value system for capital that way. So basically, we have left one city or state in order to go somewhere else to work, and we understand that where we are staying is what are our expenses, and so on and so forth. I'm not saying that we are poor, but 30 years ago or maybe 50 years ago we were certainly in the poor category. So given that, we the family, that is my father and his side of the family, were in an uptrend financially much before I was there. But now what we are seeing is just the uptrend, which is in a certain momentum. And but it is years of, I would say, learning. I think that is what contributes more. So additional funding, additional funding came from planning. Question 5 is, what capital do you suggest is adequate for the system? So adequate capital for the system, believe it or not, is 1.5 crore. I know it sounds ridiculous, but that is what it is. And how many trades should one ideally take if multiple stocks give signal at the same time? I would expect that if you're trading the system on the daily, for example, you would trade with a 35% accuracy, and you should ideally take up to 35 positions. That is 35 into 2, 70 stock futures need to come, and that is actually where the 1.5 crore value is coming from. You could take it one at a time, but the system is going to give you a lot of variance, and you will understand it in some time. I currently have 5 lakh rupee capital. So this capital is optimal in my view for trading mini lots in commodity segment, or it should be either in the mini lot of commodity segment or in the equity segment. I've spent 4 years in the market, so congratulations about that, because spending 4 years in the market means you're close to 98 percentile in trading. Now we are only looking at a jump from 98 to 99.9. That last 2 percentile jump is a journey by itself. Like the kind of journey you experience from 0 to 98, a similar journey awaits you from reaching 98 to 99.2 or 99.6, and then from there maybe another huge uphill will start. Study trading psychology, money management, and have solid execution skills in equity. Yes, I believe you have solid execution skills in equity and options, because you cannot survive only 4 years in the market. It is not possible. Nobody with 5 lakh or lesser trading capital can survive 5 years in a market where lot sizes are so huge and the costs are so huge. It has to be because of solid execution skills and equity. Solid executions as one of the many things, and it's not just execution skills. Even your spatial reasoning, your planning abilities will be vastly superior to the average person out there. Means just 4 years spent in the market. 4 years spent in the FNO market is huge. I know most traders are looking at capital. Most not traders, I would say most people who follow social media are looking at how much profit screenshot. I believe they deserve to be scammed. They deserve to be ripped off of their money. They are let's just say they're dumb. I basically, when I look at a trade position, I can almost see the experience in the trade position, and unless of course a person is outright lying, I believe that the person is 4 years in the market, is in the top 2 percentile traders in the country. So I already know it. I'm dealing with a person who's definitely above average. If you scored 98 percentile in any competitive exam, most people would congratulate you. But we all know you wouldn't make it to the top institute in the country. But it is still better than 98 percentile of the country. Based on this, how would you recommend I deploy the system effectively? as a well-wisher, I would say swallow the bitter pill and take up equities. Take up Kotak on equities, take up Bajaj Finance on equities, take up Bharti Airtel on equities, take up these obviously clearly bullish trending stocks on the equity markets, and enjoy that ride. And you know let's just say it's not about trading. Let's just say you are into the food and beverages industry with 5 lakh rupee trading capital, business capital. Then I would ask you to set up a small pan tapri, a chai corner, or something like that, where the capital investment is as low as possible. And I would ask you to be actively involved into your own business, so that the human labor cost is as low as possible, and you're not subject to theft and wastages. But if this 5 lakh ki jagah your capital was 5,000 crore, now I can't suggest become a chai wala. Then you have to be a 7-star hotel or a 5-star hotel or whatever, in order to justify growth on 5,000 crore rupees. Right? So I always say act your wage. With this, as a well-wisher, I would say quietly focus on equities. If you are the best equity trader in the country, you are going to be very, 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 very rich. And if the exchanges are out there wanting to kill the future and option segment, then let them kill it. Let them kill it. Right now also, if the exchange as much as increases futures STT by even 1 basis point, there is a literally 99% chance that I will stop trading futures. Because why should I do something stupid? I'm not addicted to trading futures anymore. I just want to grow my capital reasonably, and if I feel someone is overcharging me for doing that activity, I'm not going to engage in it. Right now, futures are borderline comparable to equity. When I started my trading career in 2015, it was cheaper to trade future than it was to trade equity. So the exchanges warranted or wanted people to trade futures and options. It was not options, but definitely futures were cheaper than trading equity. So they are incentivizing short-term traders to choose futures over equities. Now what they are doing is they are dissuading traders from FNO over equities. And if you want leverage, they want you to take up an MTF, a margin traded fund, so that you can pay the broker 1.5% a month, rather than paying the exchange 1% premium on the future contract. I don't know. I think now that the previous SEBI official has been, I think, kicked out, I'm assuming that there will be new changes, and the best SEBI officials are those whose names we do not know. So if we know an official's name or regulatory head's name, like for example, if I ask you who's the head of FSSAI, without Googling, most likely you wouldn't be able to answer. Or if I were to ask you who's the head of FDA, you might not be able to answer. So these are good officials. But if your regulator is using media to make announcements, much like how Donald Trump makes announcements, then they are not. They have ulterior motives. And the last 3 to 4 years, I think the regulators have done a very damaging job in the market. No, not just increasing cost of trading and making it difficult for retail traders to come, but they have sown the seeds of general distrust. That is, if you tell a person I'm a trader, they generally look at you as a scammer. And an individual has to work on their own branding activities to tell people that I'm not here for your money. I'm a good guy, so to speak. But I think that's the bad work that they have done, and it cannot remain permanent. It will change. The phase will get better. But yes, so I hope I've answered your questions. I hadn't really gone through them before creating this video, but I just saw them, so I thought that maybe this will be useful in some manner for other viewers also. I have not created too many videos on trading recently. That's largely because not much trading is actually happening in the markets. We have extended holidays after extended holidays. Let's just soon enough I'll get into a certain rhythm and pick up a topic like price action and create 5, 10, 15 videos on it, so that concept is learned and understood by all the viewers. If you found, I hope you found the video useful, and if there is anything that you would like to add, comment or ask, I would encourage you to use the comment section. Thank you for your time. I'll see you in another video.